Another company's doing a stock split? How original. Well, you can't blame Matt Furlong and Ryan Cohn for throwing their hat into the ring. And it's definitely on brand for this duo who know how to play the meme stock game. Anyway, in this video, we're going to quickly run through the proposal, and I'll explain the main reason why I think they're doing this, which is to add even more fuel to this option-fueled party. So let's get into it. Around market close on March 31st, GameStop filed an 8K with the SEC, announcing that they plan to submit a proposal to investors at the next annual general meeting in order to increase the shares authorized from 300 million to 1 billion. The rationale for this was to implement a stock split on the company's Class A common stock in the form of a stock dividend, as well as provide flexibility for future corporate needs, i.e. probably going to do another at-the-money stock issuance, which they did last year, a few times. The move follows Tesla earlier in the week. Hell, I just finished my video on it, as well as Amazon and Alphabet earlier in the year, and Nvidia and Apple in 2021. And also tucked in there nicely was a proposal to raise equity comp for employees. I see what you did there. Anyway, the board approved the first two proposals, but would still need to pass judgment on the actual stock split. And none of this will happen anytime soon, as it needs shareholder approval at the next annual general meeting. While the date hasn't been announced, my sleuthing skills tell me this will be in the first half of June. As for how big it could be, time will tell, but currently they have 76 million shares issued, so authorization of 1 billion could mean anything theoretically as high as 13 to 1. But given that the company is still bleeding money before the turnaround hopefully kicks in, management will likely be pretty modest here in order to preserve some ammo for another at-the-market offering sometime later in the year. As I said, I think this, like the Tesla one, is mostly just to hype up retail investors, but there are also some important impacts on the shares more broadly. While stock splits don't directly impact the shares or fundamentals, they do potentially have a material impact on options activity. Whereas investors can get access to fractional share ownership in the equities market, this doesn't happen with options. Individuals still need to buy them in lots of 100. So, if you're hyped about GameStop for another MOAS or something, and the delicious out-of-the-money calls you covet are $10 each, then you need $1,000 just to play the game at the very minimum. However, if they do say a 5-for-1 stock split, then effectively that means you'd only need $200. Now I'm not saying that this is going to turn everyone on Reddit into an overnight options speculator, but $200 sounds more like a fun lottery ticket to me. Hell, I might even be tempted to take a punt just to follow the hype train. You know, everyone wants to be part of something. So options activity up, why does that matter? Well, for every option sold, the folks on Wall Street have to actively manage their hedging. This isn't meant to be a Black-Scholes option model primer, but as the stock price increases, so does its delta. Delta is roughly the ratio of shares that the bank needs to hold per option. So as the price goes up, they have to buy more, which makes the price go up, which makes the... okay, you get it. Anyway, excessive options activity can have a massive impact on a stock, especially one as options-laden as GameStop. The extreme case here, as the folks on Wall Street bet love to dream of, is a gamma squeeze, where an option-fueled tornado makes prices go vertical and kicks Wall Street straight in the nuts. Anyway, the stock popped 16% on the news, and this hasn't even happened yet. So, if you missed the glory days of January 2021, set your calendars for early June for potentially another bonfire of the vanities. I'm Ryan, and thanks for tuning into Market Lab.